Let's tackle one of the most compelling and controversial debates in the world of finance. Is Bitcoin the ultimate way to beat inflation? As governments worldwide continue to expand the money supply and the purchasing power of traditional currencies erodes, the search for a reliable hedge against inflation has become more urgent than ever. For centuries, gold was considered the timeless store of value, the ultimate hedge against monetary debasement. But now, a new contender has emerged, a decentralized digital asset with a fixed supply. To understand if Bitcoin can truly stand up to this challenge, we need to examine its fundamental properties, its historical performance, and the arguments for and against its role as an inflation hedge. Before we start, make sure to subscribe if you want more no BS videos about Bitcoin and crypto. And without further ado, let's dive into it. The argument for Bitcoin as an inflation hedge is rooted in its very design. Its creator, Satoshi Nakamoto, embedded a set of rules into the code that are fundamentally opposed to the inflationary policies of central banks. Number one is the fixed supply. This is Bitcoin's core value proposition. There will only ever be 21 million Bitcoins in existence. This hard cap is written into the code and cannot be changed by any single government, company, or individual. This stands in stark contrast to fiat like the US dollar, which can be printed in unlimited quantities, leading to the erosion of their purchasing power over time. As the supply of a scarce asset is fixed while the supply of a currency expands, the value of the scarce asset naturally tends to rise relative to the currency. Number two is the halving. Approximately every 4 years, the rate at which new Bitcoin is created is cut in half, an event known as the halving. This predictable, programmed reduction in new supply further reinforces its scarcity. It means that Bitcoin's inflation rate is transparent and steadily decreases over time, eventually reaching zero once all 21 million coins are mined around the year 2140. This is the exact opposite of the unpredictable and often accelerating inflation of fiat currencies. Number 3. Decentralization. Bitcoin is a decentralized peer-to-peer network. It operates without a central authority. This means no government or central bank can manipulate its supply, seize your assets, or freeze your account. For individuals living in countries with unstable currencies and hyperinflation, this has made Bitcoin a lifeline, providing a way to protect their wealth from government mismanagement. In places like Argentina and Turkey, where local currencies have lost a staggering amount of value, Bitcoin's value has held up or even increased significantly, providing a stark example of its real-world use as a hedge. While the theoretical case for Bitcoin as an inflation hedge is compelling, and I am very pro-Bitcoin myself, its short history and extreme volatility present a strong counter-argument. Firstly, there's extreme volatility. The most significant knock against Bitcoin as a reliable inflation hedge is its price volatility. A traditional hedge is meant to be a stable asset that holds its value when other assets decline. Bitcoin, however, has experienced multiple drawdowns of 70% or more. For example, during the inflationary period of 2022, when inflation surged and traditional assets like gold performed well, price collapsed. This behavior makes it look more like a speculative, high-risk asset than a stable, predictable store of value. It's often highly correlated with other risk-on assets like tech stocks rather than acting as an uncorrelated safe haven. Number 2 is a lack of historical data. Bitcoin has only been around for a little over 15 years. This is a very short period to evaluate its long-term performance as an inflation hedge. While gold has centuries of history to back up its claim as a store of value, Bitcoin's entire existence has unfolded during a unique and relatively short macroeconomic cycle. There is no long-term historical data to prove its effectiveness across different economic conditions. Number 3. Speculative nature. For now, much of Bitcoin's price is driven by market sentiment and speculative demand, not just its inflation hedging properties. Its price movements are often influenced by news, celebrity endorsements, and broader market sentiment. The speculative nature means its price can be decoupled from the macroeconomic fundamentals that would typically drive a hedge asset. So, is Bitcoin the ultimate way to beat inflation? The most accurate answer is that it is a promising and emerging hedge against inflation, but it is not yet the ultimate or proven one. For now, many experts categorize Bitcoin as a potential insurance policy against financial catastrophe, particularly against the debasement of fiat currency through excessive money printing. Its fixed supply and the decentralized nature give it unique advantages over traditional assets. However, its extreme volatility and short history mean it is not yet a replacement for more established hedges like gold, which has a long track record of preserving value through a variety of economic cycles. Ultimately, the smartest approach for most investors is to view Bitcoin as a component of a diversified portfolio, rather than a sole solution. Its role is to provide exposure to a new, non-sovereign asset class with a fundamentally deflationary design. By understanding both its immense potential and its current limitations, you can make a more informed decision about how Bitcoin fits into your own long-term financial strategy. Of course, none of what I said in this video is financial advice. Make sure to always do your own research. If you want more videos about Bitcoin, make sure to subscribe to the channel. Thank you for watching, and I will see you in the next one.